know why I'm such a big believer in picking individual stocks and not sector ETFs? Just look at retail right now. Right now, the losers see a promotional environment where they need to cut prices to keep business. The winners, they see a strong consumer. They're not feeling any promotional pain. You got a clear set of haves and have-nots. The losers are desperately trying to figure out how to draw more traffic, while the winners have more customers than they seem to know what to do with. Yet so many commentators feel compelled to generalize. When a loser like Kohl's reports horrific numbers, or when a better-run company like Home Depot stumbles, we hear endless musing about how the consumer's weakening. Tariffs are starting to take their toll. Look out below. They're missing the point. When you listen to the winners like Lowe's or Target or Walmart, they tell a very different story. According to them, the consumer's flush and buying everything from gadgets to housewares to cosmetics to food to drugs. Just look at the most contentious category of all. Look at apparel. While losers like Kohl's and Urban Outfitters reported really ugly apparel numbers, Target's apparel numbers, they were fabulous. It's not that clothing is ultra-discretionary. So shoppers are delaying their purchases. No, it's that they're only buying clothes enthusiastically from certain chains, and they're dissing others. So what's the secret sauce that separates the haves from the have-nots? I've said it before. I'm going to say it again. To win in this retail environment, you either need to be online or off-price. If you're not offering a great digital experience or really unbeatable bargains, then I got to tell you something. You are in trouble. For example, let's look at Target, okay? I mean, the stock was just huge today. I mean, even when it was up 10, I said to buy it. They've adapted to the web by turning its brick-and-mortar stores into warehouses where you can buy online and pick up in the store. Meanwhile, they bought this company called Shipt, as S-H-I-P-T. It's amazing. It handles deliveries. The rollout of same-day delivery has been a gigantic growth driver. We heard Brian Cornell this morning say that in an interview on Squawk. I mean, it's one reason why the stock surged 14% today in the wake of a terrific quarter. We're seeing the same thing from Lowe's. CEO Marvin Ellison is upgrading his systems to reflect the modern-day omnichannel world. They didn't have that before he got there. If he gets a little more digital business, his operation could surpass Home Depot when it comes to comparable store sales growth. No wonder Lowe's folded 4% today in an otherwise ugly session. Meanwhile, we just learned that Home Depot's old systems are hurting their business, and they can't be improved overnight. Thanks. The difference is stark. All right, how about Kohl's? Sell. Kohl's, which melted down on Monday after a devastating quarter. Okay, their problem is simple. They don't have anything special. Kohl's doesn't have the kind of fabulous digital platform that can compete with Target or with Walmart, let alone Amazon. And you can only get away with that when you've got the lowest prices. But Kohl's doesn't have that either. It's a department store, not an off-price chain like TJX or Burlington Stores, both of which I like very much. And in this new world, Kohl's, as much as I actually like to shop there, it just isn't good enough. And that's why it's a mistake to extrapolate from the retailers to the broader economy. In a world where Kohl's is doing terribly but Target's doing great, the economy is not what's controlling this cohort. ETFs, once again, shroud the truth. Some are winning. Others can't win at all. Some retailers have spent fortunes on technology to lure customers away from the competition. They're prospering. Jobs are plentiful. Consumers have money to spend. They're just having discerning tastes, which is why they're shopping at Amazon, Target, Walmart, and Lowe's. And they are still shopping at Home Depot, but we know that was a stumble that we didn't expect. In other words, everybody who's worrying about whether the trade war is hurting retail is asking the wrong question. They should be wondering if it's possible for a retailer to thrive without big spending on technology from the likes of companies such as a Zendesk, a PagerDuty, a Salesforce, because the answer is no. I say wait for the next round of tariff hikes or nasty trade rhetoric, the president will certainly give us that, to knock down the whole group and then buy the retail winners into the weakness created by the ETF and the overall market. And please, I'm begging you, stop assuming the losers somehow give you a better read on the economy. In reality, the losers just have a worse read on the consumer. That's it. And better merchandise may at this point not even change the equation. Much more Mad Money ahead. I've got the exclusive with Tableau Software. How is the company faring now it's under the Salesforce umbrella? And then I am taking a page from PagerDuty. How can I help you? And finding out if one of the hottest IPOs of 2019 can head higher. And all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.